A very good morning to all. In today's session, we are all going to learn about the models of circular flow, national income, and its aggregates. So, what is all about that we learn in today's session? So let's begin about the models of circular flow. There are actually four models. There are two sector circular flow model, three sector circular flow model. In the two sector, we are talking about the businesses and the household. In the three sector, we are talking about the household, businesses, and the government. When we talk about the fourth sector, we are talking about the household, businesses, government, and you can see exports. In the five sector, we are talking about the household, government, businesses, even the export and any other international transactions. So these are the main four models of circular flow of income. So let's have an overview about these four models. So let's begin with the two sector model. So when we talk about the two sector model, in this particular model, we are talking about the households and the you can say businesses or firms. So when we talk about the household basically you can say produces the four main factors of productions to the businesses, such as the land, labor, capital, and the you can say entrepreneurs, or you can see the organizations, etc., or technology. So when we talk about the household, they produces all these particular factors of production in an exchange of income. And now question arises, what would be the exchange of income? That would be the wages, that would be the rent, interest, or particular profit. When we talk about the businesses uses these four factors of productions to produce the goods and services to earn or to pay that income to the household. So automatically it's a circular flow of income where the household produces the four sectors of production, and they in an exchange of income, now the business uses that four factors of production which will be used to produce all those goods and services, and ultimately to pay to the household for those factors of production. So this is a circular flow that will be worked between the household and the businesses or firms. So where the level of income and expenditure and output would be equal. So if there is a changes in income, automatically the expenditure would get changed, and ultimately the output. So when we talk about the household, they just having two main purposes. First, to produce that four factors of productions to the businesses, and whatever the income that they get, they uses that the same income to buy the goods and services from those businesses and or firms. So this is called a circular flow of income in case of two sector model. This is a particular diagram that I'm talking about, which I have explained and elaborated in the words. So this is the consumers, these are the producers. So when we talk about in the circular flow, the basically the producers are the, you can see, the households, and the consumers. The consumers are the household, and the producers are basically the firms or the business organizations. So when we talk about the consumers, where we talk about the household, what they do, they produces the resources to the ultimate firms and you can say organization, and these organizations will automatically pay the wages, interest, you can say rent, profit to the household, and automatically the consumers use that income to buy the goods and services from the producers, and ultimately from the you can say organizations or firms, and the firms will produces that goods and services directly to the household. And this is a way that the consumption spending would goes on, and ultimately called a circular flow of income between the households and you can say the firms or businesses. Now we talk about the three sector model. Already the same two main sectors which I already discussed in the two sector model, that is the households and the businesses. That when we talk about the household sector, we talk about the households. When we talk about the producing sector, we are talking about the firms or businesses. When we talk about the government sector, that is the third main component under three sector model. So when we talk about the government sector, the role of the government sector in this particular model will collect the taxes from the you can say households, from the you can say businesses or firms, and ultimately when they collect the taxes, whatever the revenue or income received to the government, they uses that particular income for the public services. It would be build up the hospitals, build up the you can see education schools for education. So that is the role of the government sector in this particular three sector model. So automatically flows from household to producer producing sector, that means how it flows will goes on from household to businesses or organization, and ultimate to government sector in the form of the taxes. So whatever the transactions go on between the household to the businesses, ultimately they both have to pay the taxes to the government, and the government uses that revenue or taxes for the public services. So whatever the income received from the government sector, it flows to the ultimately. That means whatever the amount or revenue will received to the government, ultimately it will automatically used for the public services. And for public services, whatever the sectors were involved, that is the household and the businesses and firms. So this is called the circular flow of income. That ultimately what we get, what we produce uses the same income. So automatically it called a circular flow under the three use this you can say sell the goods and services, and automatically go whatever the amount of taxes go to the government, and that will be used for public services, and of course that will be used for the payment of any transfers, payments, or any subsidies or etc. This is the diagram that I'm talking about in the four sector model. So when we talk about, you can say three sector model rather than four sector model. When we talk about three sector model, we are talking about the consumers, households, producer. We are talking about here that is the businesses or the firms, and the third one is government sector. So the whole cycle, the two sector model cycle will remains the same in the three sector model, and the new component, that is the government sector, will come under this particular model in the form of taxation and spending. So once the government receive the taxation, if you can see on the diagram, then automatically expanding to ultimately to the organizations, firms, which also includes the household. The whole cycle will remains the same. That the household will supply the resources to the producers, and the producer will ultimately exchange that resources or in the form of you can say providing them the income in the form of wages, interest, staff interest, or profit. When we talk about when they get it, and ultimately the consumers buy the goods and services to the businesses, and businesses sell that goods and services to the ultimate consumer. So whatever and the income that received by the households to the businesses and firms, they ultimately from the consumers, from the consumer or households. So whence the third new component will add on, that is the government sector. So ultimately government has a role to collect the taxes from everyone and ultimately used for the public service, which also include the organizations, firms, and automatically the households. So this is all about the three sector model. So let's begin the four sector model. So automatically when we talk about the three sector model, so in the four sector, the three main sector model will automatically include it, and whatever the roles they play in that particular model will have the same in the four sector model, and the new component will be add on, that is the financial sector. It means the financial institutions that they you can see collect the money in the form of savings and the land money to ultimate you can see their clients and the businesses or the organizations, so that the exchange process of income will go smoothly. So this is, and it goes on or it works actually mainly under the four sector model. So when we talk about the four sector model, a modern monetary economic, it includes a network of four sector economy, which has been mentioned in on your screen. The first is household sector, which is ultimately supply the resources, that is the factors of production, four factors of production. When we talk about the firms in producing or businesses or organizations, so definitely they uses that factors of productions and ultimately pay the income to the household in the form of wages, wages, profit, interest, etc. The third one is government sector, who collect the taxes and spend the same revenue or income for the public services, and the financial sector, who plays the role to provide the you can say the facilities of the lending the facilities the to borrow the money from the institutions when they have a shortage of funds, so that they can make an investments which are always being available to the organization. So each of the above sectors receives some amount of payments in the form of producing or selling the goods and services, which automatically you can see runs a flow of goods and services regularly. And when we talk about the exchange of income, the exchange of money will always takes place in all of the sectors. Household also work, also producing for money. Firms also expecting that whatever they produce or sell the goods and services for money. Government role always collect the money from the organizations or the household, which also includes the household, and then ultimately spend the money for them. Financial sector, whenever the any shortage of funds or any investment to make, so definitely the particular funds will be available to the ultimate organizations or the firms. So these are the roles that every sector would play, so that the flow of money will always work smoothly. So this is a diagram that I'm talking about. So whatever the explanation in the third, in the second, third will always be remains the same. But there is a new component has been added on in the fourth sector, that is the financial sector, who always talk about the savings and then investment. So the household, what the financial sector role plays in this particular diagram, that the consumers save their money, or you can see in the particular financial institutions. It could be bank, it would be any financial companies who always expect from the household to save money in our institution so that it could be used for further investment. So once they save money, the financial institution automatically plays a role to invest into an organizations and firms in exchange of money, in exchange of funds, in exchange of income. And that is the role of the financial sector, who always make to receive the transfer payments from the household, and ultimate the role of the financial sector use that income in the organization in an exchange of income, whether they will get the interest, they'll get the profits, so that automatically it would be beneficial for the financial sector as well as the organization and firms who are actually dealing with the mainly household, because household is the main factor who supplies all the resources to the organization, and the organization use that resources to produce the same goods and services to the ultimate household just for an exchange of income, and use that income which directly comes to the household to receive the resources from them. So this is all about the four sector model, which will be you can see used and always work very smoothly in the form of circular flow of income. So next we talk about the five sector model. So four sectors will always remains the same: the household, the firm, or you can say producing sector, financial sector, government sector, and the fifth, the new component, is the rest of the world. Here we are talking about the international transactions, where the particular model which are very closed or sustained to to those sectors will come up to the open economy, will come up to the globally, to have an international transactions, to have an export and import to the different countries, and that sector is called the rest of the world sector. So this is the called the five sector model. So this is a diagram that I'm talking about. So every explanation, whether we are talking about the second, third, fourth, same explanation would be used in this also five sector model. But when we talk about the new component, a new sector, we talk about the overseas sector. Here we are talking about the import and export of products. So for example, tea, we are talking about tea. So the households who are actually you can say producing or paying the amount for the tea overseas, and automatically you can say for the particular households pay the amount or payments for that particular product. If they demand such a product, so definitely the overseas and the particular organization will coordinate to the overseas sector, and the overseas definitely supply or produce that goods to to the organizations, and that in the form of exchange of income, so that the income would be used to supply that goods in a domestic market into another country or within the country. So this is called an overseas sector, where the import and export of products in the form of transfer payments or in exchange of income would work smoothly. So this is called the five sector models that will work in the form of these particular transactions. Now we talk about the leakage and injection. So when we talk about the leakage, we talk about the withdrawal of income, where the income always being used into an investment. We always use in the form of taxation, in the form of subsidies, So that's called a leakage in the flow. That means a leakage, a withdrawal of income in the form of government spending, in the form of taxation, in the form of subsidies. So this is all about the leakage case. But when we talk about the injection, we are talking about the introduction of the flow of money, or you can say introduction of money in addition to investments, in addition to any government spending. And you can say that's called exactly injections in the flow of income, in the flow of you can see money. And that is the main difference between the leakage and injection, where the leakage stands for the withdrawal of money, but injection, we are talking about the introduction of money into a investment or into any government spending. That's called leakage and injection. So let's focus and have a more discussion more on these particular two topics. So this is the difference. Leakage comes, that means that our savings would be used, our taxes, if we pay the taxes, our money will goes, and the imports. Imports means when we goods, you can say demand the goods from the various countries. So automatically that was the withdrawal of money in these particular two cases, three cases. But when we talk about the injection, we are talking about the introduction of money, we talk about the investments, we talk about the government spending, we talk about the exports. So when we talk about leakage, leakage is equal numerically or mathematically or symbolically. We talk about the savings plus taxes plus imports. But when we talk about the injections, we talk about the investment plus government spending plus exports. So this is all about the difference between the leakage and injection in terms of symbolically, and the terms, the formula that will be used to find out the leakage and injections in the circular flow of income. So this is the meaning, the exact meaning of leakage and injection. Leakage means that is already told is a withdrawal from the flow. That means that we take out the money for the following purposes. That means when households and firms save their income automatically, and they will be used in the form of payments, in the form of savings into a bank, in the form of import of products. So automatically it's called a leakage, because leakage always reduces the flow of income in any form of transactions. It would be between the household and the, you can say, the organizations, or mean relate to our household to government. But when we talk about injections, injections means an introduction of income into a flow. That means the income introduced and add on into a flow of income. That means the households and firms borrow the savings, that's called injections. And automatically injections also increases the flow of income. It can be take place in the form of investment, government spending, and of course the last component, that is export. So this is the exact meaning of leakage and injection. So when it's a force five sector model where I have shown in the diagram, it's a leakage where the leakage would takes place and the injection which takes place. So when we talk about the leakage, you can see in the form of payments, because it's a withdrawal of payments to the overseas, withdrawal of payments in the form of taxation, withdrawal of payments in the form of savings, because your savings will save into a financial sector. Then again, the injection. Injection means the introduction of flow into an organizations in the form of investment, in the form of spending, in the form of exports. So this is a way that how you show up in the diagrammatic presentation, the word, the terms leakage and injection. So this is all about the conceptual framework of the two terms, that is leakage and injection. Now we talk about the state of equilibrium in case of circular flow of models. So whether we to take off the five sector model or four sector model, it always shows the equilibrium condition would exist when the total leakages amount are equal to the total injections that occur in an economy, and this will be shown in the following diagram or in the following formula, that is the saving plus taxes plus imports, which is equal to investment, government spending plus export. So this is an equilibrium or a state of equilibrium or an equilibrium condition where the injections or leakages would be equal. So that means if they are not equal, then there it is an unstable equilibrium. That means it is called, in other words, it's called a disequilibrium in a circular flow of income model where the leakages are not equal to an injections. So if there any leakage, so definitely always have an injection ready in the following form of transactions. If the state of the sum total of total leakages is not equal, then ultimately it's called disequilibrium, where the particular situation, scenario, or the condition has been already shown on the screen. That is savings plus taxes plus imports. It's not equal to the investment, government spending, exports, and that states disequilibrium. What is the significance of the circular flow of income? Because the circular flow of income has always been a tool, analysis tool to measure the national income. After all, it is an aggregation of all those economic activities which deals with an exchange of money. And in other words, it also includes the income of all the factors of production, all the expenditure of the various sectors of the economy, and that will be used in the measurement of national income. The second significant importance of the circular flow, that would be the knowledge of interdependence. Obviously, the circular flow of income always teaches that about the each activity which are related to one another. So, if there is no consumption, production, and in fact the amount of production or income in a particular organizations, and automatically it will harm the economy. The next is unending nature of economic activities. So it will says that it also signifies the production, income, or expenditure have unending or infinite, have infinite nature. After all, the whatever the nature of economic activities in a would exist in an economy will never come to an end, and ultimately will never come to an end. The economic activities never come to an end in an economy. It means the national income is always bound to increase in a future. The fourth is significant in case of injection and leakage. So automatically when you have any issue, if there is any withdrawal in one sector, so automatically there is also an injection for the another sector. That means a solution to another sector, and that's called an importance of a circular flow of income. Now we talk about the you can say the national income and its aggregates, where the consumption goods, final goods, intermediate goods, stock, flow, investment, depreciation, everything involved in this. So here we're talking about the first concept, that is the consumption goods. So basically, when we talk about the consumption goods are those goods which are being purchased by the consumer as a final good or an ultimate good to satisfy their needs or wants. For example, we are talking about the car. It's definitely it will satisfy our pleasure, our comfort. Television to satisfy our entertainment needs. radio, to have you can see listen the music needs or wants. So that are all the consumption good where you buy and consume on a daily basis or a weekly or monthly basis, and that's called the consumption good. But consumption good also includes the non-durable goods where will not be you can say work for a long period of time. That for example we're talking about the fruit, we're talking about the oil, we're talking about the milk and vegetable. For example, if I order online Amul milk, so definitely it will be delivered into a 5 minutes by a service agencies like Zepto, you can say Swiggy and the Blinkit. But when then the milk will reach to a home or to a delivery addresses. So ultimately, after 1 day or 2 day, if not being used or remains unused, the milk, then automatically it will be dispersed. So that is called such type of goods are called non-durable goods and services. The next type is semi-durable goods such as crockery, even you can see utilities, and that comes under semi-durable goods, which was you can see used for a long period of time, and of course, if once used, it can be it can be reused as well. And such type of goods are called semi-durable goods. The next one is capital goods. So when we talk about the capital goods are those final goods which always being used in a process of production of another goods. So where we are talking about if you talk about the organizations, how the organization produce the goods to and reach to a market and reach to ultimate consumers is through the plant and machinery. And that goods are called even furniture, fixtures, land. We always talk about these goods are capital goods because these are the final goods which are ultimately used for the production process of other goods and of course services. And that goods are called the capital goods. The next one is final goods. Final goods are those goods which are used either for the final consumption or the for the investment. If you talk about the various organizations like Flipkart, Amazon, they have their final goods in a plate on their websites. So automatically, the consumers who are actually ready to buy and consume that product for any other consumer goods or any and whether or the goods where to buy and need further investment, and that also considered as final goods. So it also includes the final consumer goods and final production goods, which are not meant for resale. You can see the various websites, the traditional websites, the you can see the traditional goods which are not, which are actually you actually for you can see or shown on in the various websites but not for resale. You can read, you can take in information, you can use that information and consume it accordingly. There is no value is to be add on such good because automatically the goods that you use daily basis, the value will become zero at the end. And their value is also included in the national income. After all, an investment has been done for to buy such goods. So definitely their value will also included in the national income. Depreciation is always refers that there is a decrease in the value of assets the more and more that you use that particular assets due to a foreign reasons, that is a normal wear and tear, passage of time and expected obsolescence. So or due to the obsolete technology we could say, and that's called depreciation. The next one is stock. So when we talk about the stock, it refers to a quantity It refers to a quantity of an economic variable which is measured at a particular point of time. So stock could be wealth, water in a tank, a rain drop in a tank, or in a particular basket, and that's called stock. And ultimately, it is a news. So stock has no time dimension, and that is the main reason that stock is a measurable variable. The next concept is investment. So investment is always adds you can say additional value to an existing stock of capital, and that's called an investment. So when we talk about the investment, we always talk about the net investment, where the you can say, including the taxes or any other you can see the terms that will decrease the value of the investment. For example, depreciation of an asset on an asset. So that's why the net investment is equal to gross investment minus depreciation. So in these particular terms or the formulas will be more elaborate when we talk about, or when you will learn the numerical part. The next one is net factor income from abroad. So this is that whatever the differences, the factor income that we earn by our residents from abroad. That means whatever the income earned within the country from abroad, or whatever the income earned by the non-residents within our country, whatever the difference between the two incomes, the income earned by our residents from abroad, the income earned by the non-residents within our country. So whatever the difference in the income, that income, the difference of income is called the net factor income earned by the non-resident within our country. That's whatever the difference came out. That's called net factor income from abroad. Gross domestic product at market price. So when we talk about gross domestic product, of course, we are always talking about domestic territory of a country. So it is a total value of money, where of all those goods and services which has been produced within the domestic territory of a country during an accounting year, and that's called domestic gross domestic product at market price. The next one is the components of net factor income from abroad. So these are the incomes that are really any transaction, economic transaction exists. That's a part of the net factor income from abroad. The first one is net compensation of employees. So whatever the transfer payments to be done to the employees, and that's called the part of the net factor income. Net income from property and the entrepreneurships, that is also a part of the net factor income from abroad. Net retained earnings of resident companies abroad. So whatever the earnings the resident company, that means if any Indian company have an international exposure, or the you can see constructed and or build up in the another country, so whatever the earnings has been earned or from abroad, from that particular companies, that is also considered as a net factor income from abroad. Intermediate goods. The intermediate goods basically are those goods which are being used for resale purpose or any other for the further production. For example, we talk about milk. Milk is used for tea, for coffee, and ultimately it's for shop, and it's a tea shop where for selling tea. So if you see the small stalls where the if you want a tea, there is always a milk used by a tea shop for selling the tea. If you need a tea, you go to the stall and you can buy a tea. And ultimately, such particular goods are called intermediate goods. Flow. What is flow? Of course, the flow is also a quantity of an economic variable which is measured during a period of time. For example, per hour, per day, then how much the water has been recorded, you can say, on a per day basis. So whatever the water has been recorded during the monsoon season on a per day basis, per month basis, that's called flow. So flow is a dynamic concept. It always keeps on changing. You can say increment or a decrement in the quantities. For example, investment. So of course, investment is to be done according to the period. Of water in a stream, of water in a tank. So that's called flow because that will be measured on the basis of per hour per day. But if we talk about water in the per month, it not being possible. But investment is also not possible because it takes a long period of time. It would be year, it would be months as well. So when we talk about the gross national product at market price, so we are not talking about domestically. We are of course talking about the foreign sector. So it is a total value of money of all those goods and services which are produced by a country, including the net factor income from abroad, which includes the income of the residents of the country and the non-residents of the country. So whatever the earnings they get within the country or from outside the country, and that always include in the gross national product at market price. So these are the main formulas. First one is NNP/MP, that means net national product at market price. So when we talk about net, we always talk about the foreign incomes. We always talk about the losses that will incurred into a value of a good or services. So net national product at market price is equal. What would be the formula? How the depreciation has been deducted? Because when you convert net to when you convert, you can say gross to net. That means a depreciation to be deducted. So that's the main, you can say, trick to estimate or to you can formulate or you can see the formulas. So when we talk about when you go from gross to net, you have to deduct depreciation, right? So when you go from market price to factor cost, that means you have to deduct the net indirect taxes. So what would be the formula of indirect taxes? Net indirect taxes. Indirect taxes, you can see minus subsidize. So when we talk about net, I already told that once you go from gross to net, you have to deduct depreciation. But once you've gone through the from net to gross, that means you have to add the same amount depreciation. So as I told, if you go from gross to net, it's minus depreciation. If you go from net to gross, that means net stands for includes factor incomes from abroad, but gross is always within the domestic territory of the country. So if you go from net to gross, it will be plus depreciation. So it's very simple to understand. Then if you go, but how these formulas to be memorized or it will be easily understood and you can accordingly use for the calculations of the numericals. So when we talk about gross to net, it's minus depreciation. When we talk about net to gross plus depreciation, when we talk about market price to factor cost is minus net indirect taxes. And how to calculate the net indirect taxes? It is indirect tax minus subsidize. So when we talk about you can say domestic a domestic to net, it means when we talk about domestic to net, automatically you have to add on the net factor income from abroad. So if you go from market price to factor cost, you have to deduct the net indirect taxes. So if you want to go market price to factor cost, then automatically you have to reduce the uh, depreciation. So that is the key of the formulas, that how you use these terms and how you use into a formula into a numerical question. So these are the tricks that will be used. That is, if you go from gross to net minus depreciation, net to gross plus depreciation, if you go market price to factor cost minus indirect taxes and plus net factor that will be used in calculating the national income. So automatically it is very important to understand when these formula is to be used. That is the net from gross to net, market price to you can say factor cost, or factor cost to market price, then you can say net to gross or gross to net. So this is will be used in the formulas. The next one is relationship between the national product and domestic products. When we talk about domestic product, is always talk about within the domestic territories where the goods and services to be produced within the country. But when we talk about the national product concept, we always talk about it's based on residents, and the residents who have earned within the country and who have earned outside the country. That's called national product. Domestic product, whether whatever the earned, it's within the domestic territory of the country, whether it would be resident or non-resident. So it is come under the domestic country because it's dealing with one country only. But national product is not dealing with one country, dealing with two countries, whether it also include resident and non-residents. Product. National product, it includes resident, non-residents, they are earning within the country and the earning outside the countries. Everything will be included in the national product. And that's why there is a formula which has been mentioned on the screen. That is, the domestic product will always include in the national product whatever the residents contribute within the domestic territory or outside the domestic territory, that also being added, and the non-residents who are contributing to production inside the domestic territory, then definitely it will be deducted. So this is the relationship between the national product and the domestic product in this particular case. So till time that it's for today. Whatever the topics which has been described, it's a theoretical framework. In the next session, I will come up to a more interesting and important topics which will be you can see learn and having a new learning related to these topics. And till time, that's it for today. And thank you so much for listening. And namaste to all.